Thank you very much. Good afternoon and good morning for our friends on the West Coast. I'm Bill Nellen, the leader of Alliant Environmental Group nationally. We've created this informative webinar from 3 different perspectives: legal, environmental insurance, underwriting, and insurance brokerage. I'm glad to be attending this call and presenting with John McGarren and Chris McAuliffe from Morgan, Lewis & Bockius, a well-known national and international law firm with a very strong environmental practice. John and Chris will address legal environmental updates, regulatory, and emerging issues. Toby Smith, president of Ironshore Environmental Group, a strategic operating unit of Liberty Mutual, brings his unique perspective from the insurance company marketplace, discussing pollution risk taking. I will be leading off discussing the environmental risk management aspects of pollution exposures and when to consider insurance and where it might be applicable. So this opening slide will provide a framework for our discussion most generally here into environmental risk management. What is environmental risk management? Government regulations provide a roadmap for obeying the law. Environmental risk management takes it several steps further to protect the business and its strategic objectives. Let's remember, pollution damages are not death by 1,000 cuts. They're severe and could have serious balance sheet consequences. It's important to think of a team-based approach when looking at environmental issues because, again, as we're going to discuss today, it's not purely a technical issue, it's not purely a regulatory issue, it's not purely an insurance issue. It's bringing all the team of experts and specialists to bear, including insurance brokers, lawyers, underwriters, who all have a background in this discipline. As far as a lens to look at this, I'm going to break this down into a matrix where I'm going to look at transactional site pollution risks related both to being an owner and an operator or a tenant of real estate, as well as contracting risks related to projects. Then I'm going to talk a little bit more about operational environmental risks associated with owning, operating real estate, as well as contracting on a practice basis. So it's important to look at a lens of transactional site pollution risks from the perspective of financial leverage, assuming loans, committing indemnities to other counterparties, whether those have a worthy creditworthiness behind them or the counterparty credit risk is worth taking. There's a certain environmental risk associated with execution, whether or not the deal will go through, and certainty to closing. What are the exposures that you see after doing the technical aspect of environmental review and due diligence? And where potentially could insurance fit to ring fence either known or unknown liabilities associated with toxic tort, cleanup, regulatory exposures? On the contracting or project developer side, there are risks associated with, is coverage that's being brought to the job for pollution liability adequate by each trade or tier of subcontractor? Is there a reputational or image risk? Even is it a stigma damage that could come on some of the parties by performance of others that could be protected in another manner, either contractually, through indemnifications or insurance? Also, there's a project delay or extra expense exposure, which could cause suspended operations or delays. And then lastly, is there insurance or some sort of indemnity available where there's a dedicated project limit that can cover all the parties in an adequate fashion? So then on the flip side, talking about operational site pollution risks, I'd like to detail things associated with, is there a potential for environmental damage due to the product itself that's being produced? Can there be some sort of protection for income or business interruption, loss of rents in some way from environmental exposures? anybody who's been on the wrong side of a 104E request or has gotten liability tagged with the use of a landfill or a disposal site knows that there's a vicarious collateral liability associated with using disposal sites, either legally or illegally. And ultimately, if you're transporting a raw material or a waste material, there's a potential for upset and overturn and spillage or release. Lastly, as it relates to operational site pollution risks, site pollution liability coverage is not included in standard property and commercial general liability policies, so it might be worth managing that elsewhere. Going over to operational contractor or developer risks, is there an opportunity for there to be a program policy that covers all scopes of work and all services performed regardless of who holds that contract on a blanket basis? Also, can an insurance product be deployed so that that contractor or that service provider can win more work and have some sort of certainty and manage their income flow by meeting and achieving financial assurance obligations from a counterparty by buying insurance? Now, some of the other speakers are going to go in greater depth on some of these items, but I'd like to talk a little bit about some of the emerging contaminants and how those are viewed in the pollution liability risks and solutions lens. So vapor intrusion, this is an issue where maybe a site's been redeveloped, or maybe there's an unknown pollutant that's been migrating on from an off-site source, where there's the potential threat to human health and the environment relative to volatile substances coming up through floors, coming up through sumps, coming up through subsurface areas into garage spaces or contained air where there could be a health threat. Additionally, in the insurance area specifically, some of the evolution of the product, which is constantly changing and constantly being tweaked by all the carriers in the marketplace and the brokers participating in it, is for a long time, people would choose limits associated with how much would be paid out potentially in defense, and now there's the opportunity to get some portion or all of your defense costs covered outside of the limits. Some of the other, continuing on the same area regarding emerging contaminants and pollution liability risks, there's also an opportunity to cover first-party DIV. Is there a potential when there's a mark-to-market event and there's a pollution condition where you can actually point to and quantify the loss of a potential disposition of an aspect of real estate associated with environmental damage, whether it be stigma or real damage? And that can be quantified and that can be covered in a financial insurance product. Also, in a lot of states now where there are licensed environmental professionals or site professionals, there's an opportunity to put insurance in place when there's a threat of a no further action letter, a closure, or an audit provision being triggered where there's a government reopener. And this can also be a good use of insurance in managing your environmental risks. Finally, I just wanted to touch briefly on what does it take to put a pollution liability contractors or site pollution liability submission into the environmental underwriting marketplace. We're going to hear from Toby further along on how they rate and evaluate those risks. But my part here is just to tell you about, it's great to be fully disclose all documents and knowledge, because ultimately you're going to be asked to do a rep and warranty on that environmental disclosure that you make to the insurer. Also, be aware, related to that, that policies have known and non-disclosed conditions exclusions in the policy, so if you didn't disclose everything and you have a claim, the carrier will look to exclude that potentially. Also, are there options available for coverage specifications in order to test the sensitivity and the premium pricing, so get limit options, term limit options, deductible options, and policy duration options so that you can test what the sensitivity of the various markets that are quoting or providing. Additionally, whose interests are being covered under the policy? Is it just the owner? Is it just the buyer? Is it the buyer and the seller? Each one of those have different liability profiles related to federal and state environmental laws and regulations and counterparties. So it's important to know who is being insured and document that and describe that fully in your submission. And finally, carriers are always keen to know what's the future use plan of these policies or the property. Will there be capital improvements? Will there be development? Will there be change in use potential? Even if it's just conceptual, since these policies are written often on a longer term basis, 5 or 10 years, perhaps there is a change that's contemplated and everybody needs to let the underwriting community know what that is. Now I'm going to hand the mic over to Chris McAuliffe, who will be speaking further on environmental laws and regulations related to this topic.
Thanks, Bill. This is Chris McAuliffe. I'm with Morgan Lewis's Princeton office. Good deal of my practice relates to the advising of clients of environmental risk, helping them manage through those risks during their different transactions in their operations. And I'd like to talk to you a little bit today about some of the issues that we're seeing coming up more and more in some of the transactions and the businesses that our clients are doing. Clearly, traditionally, in terms of a pre-transactional environmental due diligence, the phase one has always been the workhorse. And this is the phase one environmental site assessment. Things are changing a little bit more now. Phase ones are still very important. They still serve vital purposes. They can understand, what are the risks. Maybe they're satisfying a lender's requirements. In some instances, they are satisfying a defense to liability under CERCLA as a bona fide prospective purchaser defense. But a key aspect of all of that, and something that is vitally important to understand, is, all right, why are you doing the study in the first place? To make sure it's meeting what your needs are. An item that crops up and is seeing more and more attention these days, particularly in transactions involving non-U.S. parties, are looking at issues outside of the traditional phase one environmental site assessment. And they're looking at a number of environmental, social, and corporate governance principles. Sometimes call these as ESG due diligence. And these relate to issues of climate change and sustainability, diversity, corporate management structures. You'll have questions about the equator principles. All of these will be important to your parties on the other side of a transaction. Your phase one will not cover them. And in some instances, unfortunately, your phase one consultant won't cover them. So it's important when you're going into the due diligence to understand who the parties are to the transaction and what will be required of you and what they will be asking for so that you can meet those demands to facilitate the transaction. Another issue that we're seeing coming up more and more is vapor intrusion. And you heard Bill talk a little bit about it. Several years ago, vapor intrusion became a more important part of phase one due diligence. What we are seeing more and more now are phase one reports coming out and landing on someone's desk and recommending a vapor intrusion assessment or a study of a property in which a client thought they had no issues and no risks. So I would recommend to people, before that report hits the desk, to do your due diligence up front, even before the phase one is commenced, certainly before it's finalized. Understand what the potential risks are. And if there might be an issue for a vapor intrusion, start thinking about how you're going to manage that risk going forward. This cost can be large, and it can cause some concern to the parties in the transaction. Aside from transactional, one of the underlying themes that you always have to think about as well is what's going on the statutory side. What are the statutory and regulatory obligations, and how do they impact your liability? Traditionally, we often talk about CERCLA and a bona fide prospective purchaser defense. It provides defense to liability when a party conducts all appropriate inquiry, which is usually meant to be a phase one report, cooperates with notices and provides notices, and takes reasonable care with regard to contaminants on the site. A very interesting case came out just this past year out of the Southern District of Indiana on Duprin v. Moran. And that's one of these rare cases in which the court actually looks at whether a phase one is sufficient or not to establish a bona fide prospective purchaser defense. It's a big issue. And there are a couple key points that came out of that case that are worth keeping in mind. One of the parties to this case was a party that had a long-term lease with an option to buy. And they conducted their phase one when they executed the option to buy. They did not do the phase one when they entered into the lease. And ultimately, the court said that was insufficient, that they need to have done that phase one report when they entered into the lease, not just when they were purchasing the property. There's another unfortunate party in the case in which the court determined that their phase one was inadequate because although they relied on what their consultant told them, their consultant didn't do everything they were supposed to do, including talking to the owners of the property and signing the necessary certifications. And the takeaway from Von Duprin, more than anything else, is pay attention to details. They will matter, and they could be the difference between having liability and no liability for a contaminated site. Don't forget, I talk to clients all the time, don't forget about your state law requirements. Two states in particular, New Jersey and Connecticut, have transfer statutes which impose certain cleanup and investigation liabilities and obligations on a transaction. Other states have their own voluntary cleanup programs. They've got their own bona fide prospective purchaser defenses. Understand what those states say, how you can protect yourself, and what obligations might be triggered. Another issue that's coming up more and more are military bases. As the federal government pulls back from some of its sites, these properties are becoming available. It's important to understand the process that the U.S. military goes through to remediate a site and prepare it for use and for resale. You can get some valuable protections, but only if you understand what's been done and the extent of those protections and how you comply with their notice and claim obligations. So we have talked briefly about some of the statutory and regulatory developments that are important. The transactional tools, though, are continuing to evolve, and they are very important to keep your eyes on. Traditionally, the primary means of addressing managing risk and allocated among the parties would be representations and warranties within the transaction. Great, people have become very comfortable with that. They understand the definitions. They understand what it means. I would ask people to take a closer look at these issues now. And for issues that you will hear John McGarren speaking about in a little while, a number of these programs relate to how a hazardous substance is defined, and they define it according to certain environmental cleanup regulations and statutes. There are a group now of emerging contaminants, however, that may not fit within that definition of hazardous materials in your standard contractual language. And so if you want to make sure that your clients are getting the protections or transferring in all the environmental risk that they wanted to, pay particular attention to how hazardous materials are defined in your transactional document. Think about products liability laws, transportation or worker health and safety laws, and how they might be a better fit, perhaps, to kind of manage and transfer some of those risks. As I think you heard Bill talk about, well, Toby talked a little bit more, sometimes the parties just won't be able to come to an understanding as to how those liabilities and risks can be transferred and allocated among them. And there's a gap. Environmental insurance is developing and evolving to sometimes help fill some of those gaps. But you got to be creative about it. And you got to take a look at what are the policy terms, or some of the exclusions, the exceptions, and have some careful discussions about, okay, what does this cover, what doesn't it cover, and what do we know about the site? And with all that knowledge and the kind of homework being put into it, you can really come to a place where you will be able to effectively transfer the liability and manage that risk going forward. And so with that, let me transfer the program now over to John, who's going to talk about some of those emerging contaminants that I just mentioned. John?
Good afternoon, everyone. I'm glad you transferred the program and not the risk, Chris. My name's John McGarren. I'm also a partner at Morgan, Lewis Bockius. I'm deputy chair of the firm's environmental practice. I'm going to be talking to you about two classes of emerging contaminants that are consuming more and more of my time recently, and those are known as PFAS compounds, PFOA compounds, PFOS compounds. There's a whole series of these chemicals, and there's a large amount of debate going on over which of these substances to regulate, which of these substances to test for, and whether or not these substances are going to be designated as hazardous substances. As Chris mentioned, the term hazardous substance has a great deal of significance because it's the key parameter in the Superfund statute for determining whether or not there's authority. There's several bills right now going through Congress dealing with whether or not to identify these PFOA and PFOS compounds as hazardous substances, and the bills have a lot of other associations beyond just designating them as a hazardous substance. There's a large amount of debate going on right now over these bills. The other class of compound I'm going to talk about is 1,4-dioxane, which is another emerging contaminant. And by emerging contaminants, these are contaminants that drinking water providers were required to sample under the Safe Drinking Water Act, and they have been identified as ubiquitous contaminants in places like Long Island, for example, where folks are relying on the groundwater for their drinking water. There's been a lot of developments in the past year. I'm going to talk to you about some of the steps taken by EPA and the states to regulate these chemicals, and talk to you a little bit about the litigation that's ongoing across the country. First off, I'm going to talk to you about PFAS compounds, and I'm lumping these compounds together, but they're very widely used in consumer products. They're used in food packaging. They're used in paper coatings. They're going to impact the recycling industry, the paper recycling industry, for example, because these compounds are showing up in some of the sludge coming out of the recycling facilities. They're in the workplace. They're in wiring. They're in your home. They're in your cookware. They're in your carpets, and they're in your clothing. So they've been widely used, and since the early 2000s have really come under scrutiny. They've kind of supplanted PCBs and other compounds like that as a real subject that's driving cleanups and remediation. The other compound, 1,4-dioxane, I think the most common occurrence of this chemical, which also shows up ubiquitously, is associated with its use in chlorinated solvents, in particular TCA, 1,1-trichloroethane, which was a solvent that replaced TCE, trichloroethylene. It also shows up in perchloroethylene, which was widely used in dry cleaning operations, primarily used as a stabilizer. It's been showing up on contaminated sites as a tentatively identified compound for many years. I first noticed them at least 20 years ago. They showed up all over the place. But EPA has really started to focus on them, as have the states. In terms of the mechanisms or the statutory authority that EPA is relying upon to regulate these compounds, I have three of them listed here. There's really four. The PFOA, PFOS compound regulation largely spawned out of some DuPont facilities down in West Virginia, which were under RCRA corrective action cleanup. And as a result of that cleanup, the compounds were shown to be present in the environment. That led to a TSCA enforcement action by EPA against DuPont, which led to a large penalty. There were plaintiffs' lawyers involved in inducing EPA to bring that enforcement action, and those plaintiffs' lawyers have since turned that into very large-scale litigation, which I'll talk about in a bit. So you have, TSCA, RCRA, and CERCLA, which cover, TSCA covers the safety of the chemicals. RCRA and CERCLA get involved in the cleanup of contaminated facilities, either abandoned facilities normally under CERCLA and active facilities under RCRA for the most part. But the Safe Drinking Water Act is also a driver because of the requirement that water purveyors sample for these compounds, and they're showing up in a lot of different municipal well environments. EPA is charged with implementing these statutes and has been promulgating rules with respect to these chemicals, but EPA has not issued any MCL, maximum contaminant level, under the Safe Drinking Water Act, so the states have been stepping in. I'm going to talk about some of the states that have been more active. In terms of some of the federal action that's going on with respect to PFOA or PFOS compounds, there's been a lot of activity. There was a National Leadership Summit on PFA compounds in 2018. ATSDR, which is pretty heavily involved in the Superfund program in terms of regulating safety and doing site assessments, issued a report in 2018. There's been legislation, as I mentioned, introduced, and it's active in the House right now. And EPA issued a very extensive PFAS action plan in 2019, which, if you're interested in this subject, is worth the read. In terms of the states, they have also stepped in with respect to both of these classes of compounds, largely because there are no MCLs, and it's showing up in a lot of in drinking water supply wells. In terms of PFAS compounds, about 17 states have formal policies at this point in history dealing with these compounds, and a large number of states are also starting to address 1,4-dioxane. And you can see some of the levels that they're setting, in particular New York, which is furthest along with respect to an MCL for 1,4-dioxane. They're going to set a level of 1 part per billion, which is a very low level. And there's a lot of activity, in particular out on Long Island, with respect to monitoring for these particular compounds. In terms of state PFOA, PFOS standards, New Jersey has some of the most aggressive standards there now and has taken a lot of enforcement activity with respect to these compounds. But we're talking about parts per trillion levels. EPA's action level is about 70 parts per trillion, but the states are going well under that, with New Jersey being the most stringent standards at this point in history. And they're really guidelines now. Other states taking action, I mentioned New York. They're talking about a drinking water standard for PFOA and PFOS of 10 parts per trillion. Again, these parts per trillion levels are extremely low. There's a lot of controversy over the sampling techniques and whether the sampling techniques themselves are introducing the contaminant, and that's what's being measured. But when you get into parts per trillion measurement, there's a lot of room for uncertainty with respect to environmental samples. Some of the other activities that are happening in the states are, essentially product bans. With respect to firefighting foams, there's a lot of litigation going on right now with respect to the foams themselves and the manufacture of those foams, but they're also starting to ban the use of these compounds in firefighting foams in a number of states, including New York. Food packaging has also been scrutinized, and there's kind of a joint jurisdictional role over this between the FDA and EPA and the states. The FDA has certain guidelines for PFOA and PFOS compounds used in the food industry, so that complicates some of the authority issues there. Again, New Jersey has been particularly aggressive with respect to the PFOA, PFOS compounds. They've issued a statewide directive, and this directive is issued under the New Jersey Spill Act, which is the grandfather of the federal Superfund statute, really the model for the federal Superfund statute. It was passed in 1976, and there's a tool under the State Act, which is akin to a unilateral order under the Federal Act, but the state issues this order to do or to pay. And to do would be to do cleanup, to do studies, health assessments, perhaps even medical monitoring, or to pay money to the state to reimburse the state for their costs, or to pay money to the state to actually do some of these types of activities. They've issued a directive, the NJDEP, to 5 companies in 2019, statewide directive on these compounds, and they've also issued or filed lawsuits, I believe 4 lawsuits that I've seen so far, against DuPont and 3M and some affiliated companies for 4 sites in New Jersey, seeking restoration of natural resources and payment of money for lost use. And those cases have been removed to federal court, but they're currently, I believe, there's remand motions pending. In terms of the state 1,4-dioxane standards, again, New York is poised to set an MCL of 1 part per billion, which would be the first enforceable MCL in the country. It's likely to come into fruition soon. They're sampling a lot of municipal wells out on Long Island, and there's a lot of litigation being brought by the municipal well owners against companies that they believe either manufacture or are responsible for discharges of these materials. Some of the theories of liability that are being pursued, and this can be important from an insurance perspective. There's a lot of common law claims being asserted, but are these claims product liability claims, or are they more traditional environmental claims? And those types of issues can be important in seeking coverage for some of the costs of these. But in addition to the common law claims, which we've seen before involving compounds like MTBE and some of the more traditional chlorinated solvents, there are new theories of liability we think that we're going to see on the horizon, including consumer fraud claims and claims that carry treble damages and attorney's fees awards. Who's bringing the suits? There's a lot of private party actions, individuals who are claiming that they've, firefighters, for example, who claim they've been exposed to these compounds and have developed cancers. 1,4-dioxane is considered by EPA to be a probable carcinogen. Some of the busiest lawsuits have been these municipal water provider suits, particularly out on Long Island, which was also an epicenter of the MTBE litigation. There's a recent lawsuit brought by the Hicksville Water District against over 30 companies for all of their wells for contamination with 1,4-dioxane. And these suits are particularly threatening because the treatment to remove both the 1,4-dioxane compounds and the PFOA, PFOS compounds are different than have traditionally been employed in these wells. Carbon and air stripping don't remove them. You oftentimes need advanced oxidation, for example, to remove 1,4-dioxane, and that's very expensive compared to air stripping, for example. And the feds and state agencies are also pursuing enforcement actions. The DEC is very active investigating facilities where they've seen PFOA or PFOS contamination in the groundwater and tracking it back to sources. And sometimes those sources are from other sites or facilities. What's next? We're going to continue to see a lot more activity by the states, who I think they believe they're stepping into an area that needs further regulation, particularly New York and New Jersey have been way out front in terms of setting standards. Haven't seen soil standards yet for any of these compounds, primarily groundwater standards and drinking water standards or guidelines are being issued. But when you get into the remediation side of it, you have to start looking at what are levels that are acceptable in soil or sludge, for example, so that they don't leach into the groundwater or have an impact on groundwater. There's likely to be more lawsuits by water districts as the standards are lowered, in particular in New York. And you're going to see, further federal and state enforcement. DEP, for example, is asking Region 2 to have responsible parties retest at a lot of the Superfund sites in the state because they want to know if these compounds are present because they weren't on the traditional target analyte lists that were used in the Superfund program. We're going to potentially see MCLs down the road. I have not seen any numbers. And there's going to be a lot of science focused on what are safe levels of these compounds because some of the early science that, for example, resulted in the 70 part per trillion EPA guideline was really driven by litigation. So there will be activity under TSCA, for example, to look at these compounds. I'm going to pass the ball to Toby Smith.
Thanks, John. Before I get in, I would just mention from an insurance industry perspective, the emerging contaminants are one that we're keenly watching and keeping track of. I think the PFOS issue is going to be a pretty major issue across the United States, and it's going to have some impact on both companies and insurance companies. So there's a lot more to come there. Not really part of the remarks I have today, but it's very interesting. My name is Toby Smith, and I manage Ironshore Environmental, which is a specialty insurance division of Liberty Mutual, which is dedicated to environmental and energy risks. And the focus of my comments today is really on environmental insurance policies, not in general, but which are often useful in transactional and development deals, and especially in light of the emerging contaminants and trends in environmental litigation and enforcement that have been discussed earlier today. So the environmental insurance marketplace offers a number of policies, but the ones that I'll talk about on the next slide are really the ones which are most relevant to M&A and development. So these are the main policies that come up. Pollution legal liability insurance is today's focus, and I will give a brief overview of the coverages in a PLL policy on the next slide. Other policies which may be relevant are contractor's pollution liability, CPL, and this covers the environmental liability of a contractor which arises during their work or after the work has been completed. Coverage can be written for the term of the contract of the project, plus the applicable statute of repose up to 10 years. Loss leaders in this space include risks like mold and construction defects and energy and components such as pipelines and bulk storage tanks. In addition to these products, which are generally offered in the market, there are also some specialty products that are offered and can be useful in the transactional and development context. One of those is the cleanup cost cap coverage, and coverage in this space really disappeared for a while, but there is some activity to suggest that the product may reemerge, and I think it'll probably reemerge on a wider scale in the beginning of 2020. And that product protects companies from cost overruns on remediation projects. And oftentimes transactions are held up due to uncertainty with outstanding environmental obligations, and a cost cap policy can help add certainty to future obligations, basically capping the cost of a cleanup project. Another one that's listed here is lender's impairment coverage, which is also known as secured creditor coverage. It protects a lender against environmental liability associated with a site if there's an event of foreclosure. And as lenders become more concerned with environmental liability, this can be a strong tool to obtain financing where a lender is otherwise concerned about the environmental conditions of a property. And historically, we would see this in very limited circumstances. There would be certain types of uses where a lender might require either a PLL policy or a secured creditor policy, but we're seeing it come up more and more. So they're not just concerned about dry cleaners and gas stations anymore. We see lenders requiring pollution insurance on a much broader range of exposures. The next one here is closure post-closure, which is really limited to certain types of property uses. So you'll see it in the mining world for reclamation. You'll see it in landfills for closure post-closure. But it's really insurance to satisfy federal and state financial assurance regulations. And the classic example is the one I just mentioned, which is the landfill operator. So a landfill operator is required to guarantee that it has funds to properly close and monitor a landfill after operation cease. And this can be done through a number of mechanisms. It can be done through the insured's own financials, if they can self-test. It can be done through a surety bond, but it can also be done through the general insurance market through a closure post-closure policy. And the final one I'll mention here is really not a standard policy that you will see, but it's really a manuscript policy that's done for specific liabilities, but it's a liability stop-loss insurance. And again, it often can be a holdup in transactions, and it's really a manuscripted policy which is written to protect against a very certain types of liabilities. And most frequently, you'll find that they're written for asbestos liability, but they can also frequently be written for other types of liabilities, including benzene and silica product claims. this next slide really just goes through, the first policy I mentioned was the PLL policy, the Pollution Legal Liability Policy, and it's a very comprehensive policy, and it covers both first and third-party damages, and the listed policies are all here. So it covers cleanup costs to address pollutants which are on or under a covered property, for instance, to address impacts to soil, groundwater, sediment, or indoor air. It covers cleanup costs to address pollutants which have migrated beyond the boundaries of a covered property, and that contamination may have migrated off-site via the groundwater. It may have migrated off-site through discharges into waterways or into the air. The PLL policy also covers your traditional tort coverage, so third-party claims for bodily injury or property damage. It covers natural resource damage claims, which I will touch on a little bit later in the slides. It covers pollution arising from your transportation or for transportation of third parties on your behalf. And the final two, it covers pollution arising from waste disposal, so your typical PRP claims under RCRA, and it covers first-party business interruption. So if your operations have been interrupted by a pollution incident and you've lost profit or you have extra expenses because of that pollution, the policy will also pay to make you whole for those costs. So that takes us to why would you purchase PLL coverage for a property or company being acquired or developed? And this is one of the things that leads to a lot of discussion. So remediation costs are often one of the largest concerns when you're considering purchasing either a property or a company. And generally, cleanup coverage is only provided for unknown contamination. So as transactional negotiations are often focused on quantifying and apportioning liability for the known issues, we often get questions of why you might think about purchasing the coverage if the known issues are not going to be covered. And most known issues on a PLL policy are excluded for cleanup costs. And so why are PLL policies still useful tools? And one of the main reasons is because it does cover unknown conditions. And so it's really going to come down to how comfortable you are with the site conditions. And this is often very difficult to quantify, especially as you're dealing with larger brownfields and heavy industrial sites. So things you're going to need to consider are how well was the site delineated, meaning how many soil samples did they take, how many groundwater samples did they take, were all the relevant constituents tested for, and if there's not really a complete delineation, there still is a potential for unknown contamination. And as we heard earlier, there's a large number of emerging contaminants that are out there that weren't tested for 5-10 years ago. So these policies can often be written for up to 10 years. So if you had a site that used PFOA, for instance, 8 years ago, and you placed a 10-year PLL policy, it's very likely it wasn't tested for. It's actually certain that PFOA wasn't tested for at that site, and that's something that could come up later and be unknown contamination and be covered. So the unknown contamination is really a big reason why PLL can be useful in transactional and development deals, but it's also dealing with the scope of the known contamination. So even though known contamination is usually not covered for cleanup, the scope of the exclusion can be narrowed. So it's very important that you negotiate the scope of the exclusion when you're placing a PLL in relation to a transaction or a development. So can the exclusion be limited to a specific area of concern? It might be a oil water separator that was the site of a release. So instead of excluding chlorinated solvents across the entire site, can the chlorinated solvent exclusion be limited to the oil water separator? Can the exclusion be limited to a certain media? So sometimes there's contamination in soil. Can it be limited to soil? Can it be limited to groundwater, et cetera? Can it be limited to just on-site? So if there's enough data, oftentimes you can limit an exclusion to on-site and give back the off-site. So if it's found to have migrated off-site, you would have coverage for that. And very frequently, if not in the vast majority of occasions, you'll find carriers willing to give you back bodily injury and property damage claims, which the definition of property damage includes natural resource damage. They will give that back even for the known condition. So that's another reason. And finally, in sort of limited circumstances, if there's strong indemnity wording from one solvent party to another, not a chlorinated solvent, but a financially solvent party, you can find that some markets will not exclude the known contamination and they'll rely on the indemnity. Additional reasons why you should think about purchasing PLL for transactional and development deals are toxic tort claims. So what we're seeing in our industry is a real dramatic shift in outcomes in toxic tort coverage cases, toxic tort litigation. So settlement and verdict values are increasing. And it has to do with a lot of reasons. It has to do with social inflation. It has to do with the political climate we're seeing. It has to do with some of the emerging contaminants. But a great example, I think, is the Roundup litigation in California, so glyphosate litigation. And if you went back 5-10 years, the verdicts you're seeing today are really just astounding. So the current verdict averages per plaintiff are over $50 million, and that's after judges have reduced jury verdicts for 4 or 5 plaintiffs, which exceeded $2 billion. Again, 5-10 years ago, we were not seeing anywhere near that type of activity, and we expect that to continue for the near future. And also, juries are finding fault in absence of negligence. They're trying to find deep pockets to pay for harm that's been caused. Another reason to purchase PLL coverage is what we've discussed briefly before, is natural resource damage claims. So there's always been natural resource damage claims in our business, but we're definitely seeing an increasing trend there. And a good example of that is New Jersey. So over the last couple of years, there's been a pretty dramatic increase in activity in NRD claims in New Jersey. And a lot of times you'll find that sort of correlates with political party that's in office at the time. But we expect, as New Jersey is a leader in the environmental regulatory space, we expect that to sort of fan out across the U.S. So we expect to see more NRD claims over the next few years. PLL can also ensure funds are available to satisfy buyer and or seller indemnifications. It can satisfy lender requirements. It can fill in gaps in other insurance, such as pollution exclusions, constituent-specific exclusions, such as lead and asbestos exclusions, owned property exclusions. So a lot of insurance, general liability insurance, will not cover any damage to property owned or operated by the insured. It's not the case for the PLL policy. It can support the placement of traditional reps and warranties insurance. So you'll find that the traditional reps and warranties carriers will often be fairly cautious with environmental risk. And what they'll typically require is a $10 million PLL policy before they will pick up any of the environmental reps and warranties in their policies. And the final reason is most of the discussion that we've had is focused on what's happened before your transaction. But one of the loss leaders in our business is really what happens after the transaction, new conditions. So it really depends on your type of business. But in a lot of the business that we're seeing, mold is an industry loss leader and got increasing frequency and severity. And mold claims in excess of $10 million used to be fairly rare, but they're not anymore. It's becoming a regular occurrence, especially in certain real estate classes, hospitality and healthcare and others. So mold is a new condition that I would keep an eye on. Fire and explosion has always been a loss leader and continues to be. You've seen a lot of it in the news, especially in the energy space, the ITC fire in Houston, Texas, et cetera, and then oil and chemical spills, so pipeline releases, things of that nature. This slide is really just to give a really brief overview of how do you acquire environmental insurance. And before going into the items listed here, one thing I would say is there's another misconception that you need to provide this tremendous amount of information. Without it, there's no way to get environmental insurance. And if you went back 5, 10 plus years, that may have been the case. But in today's environment, we have a tremendous number of tools that we can access even without information directly from the insured. We can access satellite images. We can access environmental databases. So we can get a lot of information on the site even without a really detailed submission. So I would say these are the things that are very helpful to the placement. But if you don't have these things, I would still pursue the coverage because there are often ways to get around these items. So the basics are who's covered. Is it just the buyer, just the seller? Is it both? What are the site details? Is it a manufacturing site? The building, size of the buildings, that type of thing. What are the future plans? Are you going to develop the site? Are you going to change the use? Is it going to go from a manufacturing site and you're going to raise the buildings and make it mixed use? What are the terms of the purchase and sale agreement? How does liability flow in the agreement? What are the indemnification terms? Is it as is, where is? Is there an indemnification or an assumption? Those types of things are very helpful in how we evaluate the coverage. And obviously the most important thing, especially on more complex sites, is the environmental report, so the phase 1s, phase 2s, et cetera. finally, just some points on the environmental insurance marketplace. I think it's one of the best times to engage the market. There's a large number of carriers with extremely experienced underwriters, many of which have come from legal backgrounds or environmental consulting backgrounds. Dealing with transactional and development deals, there's a significant appetite for manuscripting, so you can really negotiate these policies. They're not contracts of adhesion. You can really get them to fit the transaction you're dealing with. There really is the most competitive pricing in the history of this market, especially on CPL, which we talked about. You can get long policy terms. There's a long tail in environmental risk. You might not find issues right away. It might take until you do a development or a lender requires you to do a site investigation. So you can buy terms up to 10 years. There's more capacity than there's ever been. Individual markets have capacity up to 50 million, and the total market capacity is really in excess of 500 million. And there's really broad risk appetite, so small development deals all the way up to the most complex industrial sites. And with that, I will turn it over for questions.
Okay, we got questions.
Hey, everybody, this is Bill Nellen. In the final few minutes that we have here, we've gotten a few chat questions, so I will take the first one and give my perspective and then hand it over to Toby for a brief response, and then there's one that's in the queue right now that I think John and Chris could handle. But the first one is, in your opinion, what does the future of the environmental insurance marketplace look like? So from my perspective, and I think Toby just touched on it, but it's never been more robust, more secure, and as well financed. There are upwards of 40 carriers. Don't make me answer who they are, but there are upwards of 40 carriers that are writing the product right now, and either they're doing it as an accommodation to their other customers, or they are actually out there in the marketplace broadly advertising that they're in the pollution risk marketplace. So I would say that I see the future looking pretty broad, and despite AIG's exit in 2016, I think that was an adversely selected occasion, and I think that the market will continue to grow, and you'll see more and more capabilities and enhancements brought into the products to make them more and more applicable to people's needs. Toby, do you have anything on that?
I would agree. I think the market's very stable. I think in terms of coverage, there's very little retraction. Pricing has never been better. There might be some areas that are notable. So certain real estate classes, you might find that mobile terms are changing a little bit, but for the most part, people aren't saying we won't write the exposure, we won't write the industry. You might just find you might be subject to higher deductibles. And I think really the security of the industry is really going to depend on how responsible the markets are over the next few years. A lot of what's happening in the emerging contaminant space is relatively scary. It's emerging very quickly, faster than most things have ever developed. But those who are cautious with PFOA, PFOS, the general PFOS chemicals, I think will look back 10 years from now and be in a much better space than those who do not.
Okay. Well, this is Chris. Let me add in. There's another question that just came up. And the question is, what are some of the most frequent environmental risk mistakes you see your clients making today? And so to add in, our clients don't make these mistakes. Our clients have good advisors, and so they avoid them. But let me kind of talk generally about the mistakes that I think we're seeing more and more and that are easily avoidable. And I think the primary one really is a client in either the buy side or the sell side relying on an inadequate Phase 1 environmental site assessment. And they will rely on a report that's done quickly, with not appropriate diligence. It may be done by the other party to the transaction, and the party who is thinking to rely on that report will rely on the report to say, okay, I know what's going on in this site, and I have a protection from liability, but will never read the report and understand what those real risks are, understand what the data gaps may be, the things that the consultant did not look at and therefore aren't covered, and then really understand whether that report gives them the defense to liability that they're looking for. because when they wind up in a litigation context, the opposing party will try to pick at every little piece of that phase one to demonstrate how it does not satisfy the all appropriate inquiry standard. And a quickly done phase one that people didn't pay much attention to at the beginning of the transaction will not give them the defense that they wanted.
Yeah, I agree with that, and this is John McGarren. The EPA guidelines, there are 8 or 9 different factors that you have to look at in trying to meet the bona fide prospective purchaser exemption to liability. Due diligence is a key one, and having been involved in litigation of these cases, the other side will challenge you. They will look at the ASTM guideline, compare it against your phase one, and oftentimes we've seen that there's been holes, and wherever there are holes, there's room for mischief.
Yeah. In addition to holes, let me add to that one aspect, is clients often don't look at the dates either on these reports. Phase one reports do go stale, and so you need to make sure that the party can rely on it, that's been done in a timely manner. And if you're in a transaction, the opposite side gives you a 5-year-old phase one, says, here, you can rely on this, you can't. You need to redo it. And so that's another key mistake that we see coming up in kind of, environmental risk management issues in transactions these days.
And one other thing is, normally on the buy side on the insurance here, I would affirm what was said by the other panelists, that the market is coming back, having lived through the AIG finite risk nightmares. Cost cap policies disappeared. Products are starting to show up again. They are a key component in the deal-making world. When you're acquiring plants, a great way to bridge some of the risk issues is with insurance, and we're just seeing a lot more activity, kinds of products.
Well, thank you to our panelists, John, Chris, Toby, and for our attendees. We appreciated your attention, joining us for an hour today, and valued your time, and the questions were great as well. So look forward to doing more of these, and you'll hear more from Morgan Lewis and Alliant in the future. Have a great afternoon.